modern history. So now maybe if we put a price chart over this price range here, you've got your 75% correction. So this is an area in Bitcoin where the state of the market psychology is going to be the same way every time, right? I mean, anytime you have a 75% correction, obviously you can't say with certainty what will price action will do after that point, but you can know with a certain degree of certainty that the state of the market psychology is in a certain state, and that state tends to make the market play out in a predictable fashion. And in this case, most people in the market are in a state of fear. If they're the type of person who was previously bullishly biased, and maybe if they're bearishly biased, they're in a state of euphoria. It's hard to know exactly, but the market is at extremes. And that's the point to point out. And of course, when markets are at extremes, those are generally the points of maximum opportunity. Sort of just illustrating my point. Here's an interesting piece showing the number of news articles mentioning a bear market rally. So somebody graphed this, just charting, aggregating the number of media news articles referencing a bear market in Bitcoin. And you can see here when you get these spikes here, it's generally at lows in the market, right? This type of news reporting is it's not foreshadowing a coming decline. It's actually typically showing a bottom in price, but really what it's doing is it's capitalizing on this state of the fear in the market, right? It's advertising to the market what the market wants to see, right? Or what the people reading media material want to see, because they're in a certain psychological state of mind, and they're resonating with a certain type of information. And again, this is just the type of thing, where markets are always going to be the same for the rest of history, just because human psychology is not going to change, at the very least for thousands of years. Now, another thing I want to bring your attention to is this area. This is Glassnode data. It's Bitcoin net realized profit and loss. I think I discussed this earlier, but basically what this graph shows is that Bitcoin on the Bitcoin network, the realized loss, right, the capitulation on the network is at levels that haven't been previously seen before. So whenever you get an extreme read on an indicator like this, it's a good indicator of capitulation and people taking their losses in the market and moving to the sidelines and then eventually getting out of the market. Now, there's a couple other slides sort of illustrating that further, and I'll just touch on those quickly. Right here, so previously we talked about the net realized loss, but this is graphing the net unrealized profit and loss. So a little bit of a distinction there, but similarly, it does kind of predict these generally areas where you'd want to be accumulating, right? It generally marks off areas that typically serve as bottoms in the market. These are areas in the market where you have a purge, right? When Bitcoin gets to these levels, it's generally on the back of a deleveraging event. The market, major players in the market are getting over leveraged and getting blown out, and that's exactly what we've seen recently. So also the grifters and sort of the Ponzi's in the market, people using shitcoins to acquire more Bitcoin. All the junk is getting swept out of the market, but the Bitcoin supply is producing another block every 10 minutes. So generally in these areas, the people holding Bitcoin in these areas are generally the people who understand what it is that they're holding and why they're holding it. And so you have a situation where the market is moving coins from the hands of people with low conviction to the hands of people with strong conviction. Again, that's broadly speaking. It doesn't, take into account trading, but as a general rule, that's typically what the markets do. Now, another thing I want to draw your attention to is this is a really interesting graph or chart graphing the some capitulation within the stablecoin market. So what we showed previously is capitulation in Bitcoin is, Bitcoin is being sold at a loss and, either moving into dollars or moving into stablecoins. Well, the thing is when it moves into stablecoins, it doesn't really get at capitulation because, that could represent capital that's still waiting on the sideline, ready to get back into the market, whenever they feel comfortable getting back in the market. But when you see this indicator, this shows supply of stable coins then being taken out of the market. And what that represents is capital actually leaving the market, right? This capital that's leaving is leaving the sidelines and getting entirely out of the market. So it's a good read for capitulation. Now, there's a lot of different ways to interpret that, but I think there's a confluence of factors here pointing to capitulation in the markets. You can see that in the Bitcoin mining revenue per terahash right here. Bitcoin is just getting incredibly difficult to mine right now because the price is kind of collapsing into the cost of production. And at the same time, you have hash rate increasing very fast. So there's a lot of people trying to mine Bitcoin, but the price is not very high. That's why you see the difficulty adjustment skyrocketing. Personally, I think that miners are smarter than the rest of the market, and that they're front running an increase in price, sort of in the way that the bond market is a good indicator for what's going on in the traditional financial markets. But again, who knows as far as that goes. You do see miners getting capitulating and getting washed out of the market. Maybe if their margins are too slim, they can't hang on. You have this Bitcoin hash ribbon indicator collapsing, generally a sign of miner capitulation. Let's see. So right here, this is a really interesting metric. This is kind of capturing the a little bit of the macro. This is it's indicating the macro opportunity that exists in the market. Again, I wouldn't put too much stock in that. I tend to focus primarily on the weekly 200 exponential moving average. Weekly 200 simple moving average. Now here you see Google search volumes increasing. That's interesting. It might indicate an increase in demand among retail. Generally not what you want to see. But again, at some point retail will have to get pulled back into this market at some point. And generally the only way to do that is to push prices much higher to make retail at least feel comfortable entering the market. Here's a good Glassnode indicator showing Bitcoin relative to the 200-week moving average, just kind of graphing the price on more of a linear scale, showing how little time price spends at the 200-week moving average. Now, just going back to the chart, if you want to implement the component of time into this, the Bitcoin, if you were to go down into these time spent at the weekly 200, compared to the entirety of Bitcoin's price history, it spends roughly about 3% of the time at the weekly 200. So 3% of the time, but a lot of people are selling at these levels. I mean, it represents a capitulation environment. Now, 3% sounds like a very brief amount of time, very short. And in the case of a V-shaped recovery, it is. But if you spend multiple weeks or even a few months, which is just brief in the grand scheme of Bitcoin's price action, it still feels like a significant amount of time. And of course, the longer that the price grinds out at that level, probably the more capitulation you would see. Again, just something to keep in mind, where the state of the market is currently. There is some interesting things going on in the market. So the S&P 500 realized correlation is pretty low. Now, it was very high on the recent downturn, right? When Bitcoin went from roughly 48,000 down to now the lows of 20,000. The correlation was pretty strong until they hit the lows. But recently in recent price action, you're seeing that correlation kind of decorrelate. So it's important to keep in mind that this is very difficult to play, because if you're operating at a 25% correlation, that's no correlation at all, and this can be difficult to explain to somebody who is used to trading the correlations between the S&P 500 and Bitcoin, because it's popular to do. This graph doesn't really give you a good way to understand that. Now, of course, you would want to trade the correlation when correlation hits the higher percentage, but it doesn't spend a lot of time at the higher percentage, except for this case right here, where it did spend a considerable amount of time in that realized correlation, where you do have a significant edge. But I think the way you would want to trade that is, a lot of these guys trading it on Wall Street who are trading the correlation, they have a lot more intermediate time frame correlation, where that if you were to go stay on the New York session during certain time periods, probably towards the end of the quarterly close, quarterly open, you'd probably see that correlation peak. So this is not very tradable information, but just interesting nonetheless. Now, this is something that the GBTC premium discount to market value, that's something that is really interesting, because I think one of the components leading to the blow up in a lot of major funds that we've seen in the crypto market, you've seen the Celsius blow up. Goldman Sachs comes in, is actually acquiring some of those assets and buying them up. Well, I think one thing that was happening that not a lot of people talked about during that situation is a lot of these players were trading the GBTC premium. And for those who don't know, this graph doesn't really capture it, but GBTC was trading. GBTC is an institutional grade investment product tracking the price of Bitcoin. It's basically a paper claim on the price of Bitcoin, but not Bitcoin itself. And although it's designed to track the price of Bitcoin for institutional investors who, for whatever reason, can't hold spot Bitcoin, it traded at a discount, and a very significant discount too. So, you at a 20% discount relative to spot for some time, and all the way down to a 40%, I believe, a 40% discount during the recent crash. And one of the things that happened to some of these funds was they were essentially trying to arbitrage the discount on GBTC. So they were buying the 25% discount on GBTC, going long GBTC, and going short spot, expecting that discount would, reach parity essentially, and that the discount would, that the GBTC discount would approach spot. And in doing so, they sort of discounted the risk that was in there. They sort of operated on the assumption that they would achieve parity. And obviously the opposite happened. The discount premium widened. It widened from 20% to 40%. So that trade was a absolute disaster. And if it was a leverage trade, for a lot of these big funds, I personally think that was something that contributed to some of the massive losses, because it's one of those things where I don't think they were able to properly analyze the risk because of a certain set of underlying assumptions that they approach the market with. Now, another kind of broad view thing I want to point your attention to is this U.S. average new home sales price. This will tie in, and we'll transition to a broader view of the market, but this just gives you a good idea of like where the average American is in relation to the broader economy. So even though the Fed is fighting interest rates and tightening the monetary system, housing prices compared to per capita disposable income is going parabolic. And what that means on a practical level is that, American citizens are less able to afford the ability to acquire shelter, to purchase a home. It's getting increasingly out of reach. Now, as interest rates rise, the sales price of homes in real estate, it will decline. But I think what this graph captures is sort of a good view of what's happening on the long term, right? Personally, I think you're seeing a break of sort of this range-bound home price to capita income, and you're seeing it sort of get out of control, essentially. And so while interest rates may contribute to a short-term decline in this graph, I think the graph captures the multi-decade sort of horizon that stands before American citizens, as each credit expansion that follows in the next few years will contribute to their inability to purchase new homes. So it's kind of a sombering reality, but it is what it is. It's just something to keep in mind. Now, going back to the charts, we're looking at the Bitcoin chart, but it's very difficult to talk about the macro and quantitative tightening and quantitative easing without talking about the Dixie currency index. Now, the way I look at this chart on Dixie is you see this high formed by the March 2020 Black Swan event right here, and you see price going parabolic, right? So price was, operating pretty well right until November, and then this is really when the Fed started indicating their desire to raise interest rates, and then, of course, that's the point where the dollar currency index starts going parabolic. But it runs up, it goes parabolic above these highs right here, and then now I would make the argument that it's entering a different phase of the market where the state of delivery of the market is changing, right? You may have seen the conclusion to the parabolic run, and now you're seeing a little bit more of a distributive phase, and that's pretty common when you approach, you surge through an area with this much liquidity. Generally, price will stall a little bit because price is in search of liquidity, so it's found it. And then typically after that, it'll enter a little bit of a consolidation environment. And this is where, if you were going to see a reversal or a swing failure pattern, right, you generally look for it with these historical contexts in mind. And if it were to form, all you would need to see is a lower low on the daily chart. Within the context of that higher time weekly, and it's just a beautiful trade. Now on the weekly, you do see, you're seeing also that evidence by the RSI. You're seeing, bearish divergence on the RSI. Of course, it's not confirmed until this low is taken out here. But the general idea is that you're entering a little bit of a distributive phase. Now, it's important to keep in mind that, you can get another push up above the high, right? Maybe run up just above the high, set in that third leg or third drive. But what the point is that price is probably not going to go parabolic from here. It's probably going to work its way around and then make a decision one way or the other. But this is probably a volatility contraction period, and whether price comes down here and sets a low here and then rallies up and sets a new high and then comes down and sets a low here, you're going to create this type of trend line that's not exactly a parabolic trend line. At least, again, price can go parabolic, but this is what I believe to be the most likely scenario. And so, you get this consolidation phase above the old highs. And really what happens in this point is, at some point, price will make a decision, right? It'll enter this consolidation phase, and volatility will likely contract, but then at some point expand. And if it expands to the upside, then things do get very interesting. But if it expands to the downside, then there's some very, predictable levels to look for price to expand to. At the risk of getting ahead of myself on this, I do want to say that, there is no break of structure in the dollar currency index, but, typically parabolic markets do retrace. And if you see them start to stall and enter distribution patterns, generally everybody who made the money on the run up, they're taking profits up here, and at least the smart money is taking profits, and it's just generally a good idea to be on the same side as those people. Now, if we go to the S&P 500, actually, I think NASDAQ would be the better one to look at. So yeah, NASDAQ is testing this consolidation area here, and you see it doesn't react directly off this top right here. Some of the volume does come in at that top again, right here as it approaches this level right here. You see the volume come in right there, but then you get a run of those lows more into the core support area here. And that's generally typical behavior that you see. I mean, price, will generally work its way around these levels. Now, keep in mind, one of the reasons why this level is significant is because the amount of time price spent at this level, and that's seen by how there's this pretty big consolidation there. You can mark off right here. So from this high to the break of that high, so you get one test up there roughly in late August, and then you get a break sort of around November of 2020. So basically most of autumn roughly, or an entire season, 3 months, was spent in this consolidation range. So that's a significant area, and really it wouldn't be that crazy for price to spend the same duration of time within this region. So it tested it in early May. That's when the volume came in. So 3 months from that test would put us sort of around August So again, that's pretty far away, especially if you're watching the market every day. That's 2 months. That's a long time. Now, again, there's absolutely no guarantee that would happen, but it's just a different perspective to think about how these levels play out with the component of time in mind. So now if we go look at crude oil, we'll see if we got any significant developments here. Now, oil. I'm pretty bullish on oil, commodities in general. Actually, post a whole video on that. If you're interested in seeing that, just look at a video titled "Constructing a Bear Market Portfolio." In that video, I line out, what if somebody gave me $1 million, what assets I would allocate those $1 million to, and really, I would have the bulk of it allocated to a basket of commodities and some of the most liquid commodities. Bitcoin, of course, too, but also with a major cash position, just because even though the market is approaching that level of fear, in those extremes, extreme things can happen, and it's always good to have somewhat of a cash position on hand, just in case, something extreme happens. Now, of course, oil is the most liquid commodity of them all, and really the one leading the charge in the commodity bull market. You may see, or we may see a short-term decline in commodities. I think that's probably actually to be expected. Whenever anybody catches on to the idea that commodities are in a bull market, or oil in particular, then everybody goes long oil, and you get a short-term correction. But the fundamentals in the market are such that that commodities in general are going to be, it's the type of macro environment most well suited to them, and this stagflationary environment, and with the backdrop of rising interest rates. So over the long term, I think you'll just see commodities generally appreciate in price, and I think you'll see capital flow into them from institutional investors, mostly leaving the bond market, just because bond investors are getting slaughtered right now, but also from other markets too. And I think one thing worth mentioning is that if you're bullish on Bitcoin, then you should also have gold as a hedge, because what gold really represents is everything Bitcoin's trying to be. And in my opinion, Bitcoin is superior to gold in many ways, but a lot of central banks own Bitcoin, own gold, and you could have a scenario in extreme fear where some of these institutions move towards a bearer asset commodity, the one that has the longest history, thousands of years, and so you could see a flight to gold. Again, I think I would hope that investors are smart enough to realize that Bitcoin is the new renovation of gold, and superior to many ways, and the asset that that you would want to acquire for the same reasons you would acquire gold. But you never know. I mean, some of these institutions are pretty old, and precedent is something important to them. And so really if you think about what is the most bearish thing that could ever happen to Bitcoin, essentially is saying that if every central bank around the world came out and said, we're now going to go on the gold standard again, we're bringing back the gold standard, and all your currency is going to be redeemable for gold. Well, they wouldn't even have to do that. If they just came out and said that they're going back on the gold standard, then that would be the in my opinion, the absolutely most bearish thing that could ever happen to Bitcoin. So if you are bullish on Bitcoin, you should have a very small amount of its direct competitor in a way, in an allocation that represents your conviction in each. Um, but sometimes a hedge is very important, because a hedge is sort of casting a vote towards the reality that whatever narrative or macro idea you have formed could be wrong. And whenever you do that, whenever you implement that element of uncertainty into your trading regime, that's bringing you more in line with the realities that exist in the market. So while I'm very bullish on Bitcoin in general, and I think this price in the market represents a extremely unique opportunity, I'm also, if I were managing a large amount of money, if I were managing, these huge, 10 million, 100 million, billion-dollar asset funds for clients, I would not be allocating that all 100% to Bitcoin, because it's a lot of the benefits of Bitcoin can be utilized without having such a high allocation. And also, we don't know exactly what the future will bring. One of the most certain things about Bitcoin is that over the long term, it will go up in purchasing power, just simply from supply and demand. And of course people will say, well, how do you know demand is going to go up? Well, demand is going up. A lot of institutional clients are offering new crypto services because of citing increasing demand. For example, Northern Trust, just opened a crypto division. They have $1.5 trillion under management. You have Goldman Sachs opening a crypto trading desk. Also pouring money into the space to acquire Celsius, the lending platform that recently blew up. So, you have these entities, pouring money into the space, drives demand up, and of course the supply of Bitcoin is constrained, it's fixed, we know exactly what it will be. So one of the most certain, the biggest certainties in any market across the board is that Bitcoin will, be worth more than it is now in a few years. If you have a time frame of 4 or 5 years, Bitcoin, has always appreciated in price just due to those underlying supply-demand dynamics. And so that really brings the date of the halving, the 2024 halving, which I think is targeted for April 2024. So to put this in perspective, and this is exactly why I would not, especially if I wasn't, if I was managing a lot of money, I would not allocate it all to Bitcoin, is because how far out that halving is and the reduction in supply. So, because we don't know if price will enter a prolonged bear market or do something different, do something unexpected. But we know that the cost-benefit analysis, the risk-adjusted return, changes after the halving. So, I think being a little, having a smaller allocation of Bitcoin, is relatively, keeping yourself open to the possibility that we could have an extended bear market. Again, I'm not saying that will happen, but it certainly is a possibility, and something needed to prepare for. I do think that price is very extended right now, so in the short term, it's very difficult to make an argument for opening a short position or selling Bitcoin. really the opportunity, in my opinion, is right now and on any retrace off this level. So if I were to mark off a support and resistance, the obvious one is right here, this level right here. This one obviously acted as support for a very long time. Price came down there, reacted off it, roughly reacted off this level as well, and then when it was broken, acted, filled the price extension, slammed down. Now, when the support and resistance is obvious as this, generally, and all your on-chain indicators, your supply-demand dynamics, your RSI is massively oversold, you're at the weekly 200, this is generally the area where, if the market does bottom out, it'll just rip through the resistance and rip much higher. You see that right here. I remember trading this area in Bitcoin, and you have a similar setup. Bitcoin bottomed out at the weekly 200, and then this was the big bad resistance overhead, and Bitcoin rallied up into so it went up into the big resistance up here, and that's where everyone was drawn into the market to enter a short position, and of course that's where price went parabolic, blasting through that resistance right there, running up into a 618 retracement, almost exactly, you can see right there. So keep that in mind. I think you have a similar setup here with the big bad resistance, and then the bottoming price action down there. Again, no guarantee, but I think the idea that this is like big bad resistance is not helpful, right? It's not. I would not look at this and interpret it as strength. Now, it is technically resistance, and I think trading it as resistance is, definitely fair and definitely valid, but I just wouldn't interpret it as super strong resistance for the reasons that I mentioned before. I would actually be a little bit more hesitant, and I may trade it out of principle, but if I do trade it, it may be with slightly reduced risk. Now, when in the previous example, when price broke through, went parabolic through that big resistance and trading to 618, that could be a scenario here that you see, and this is operating under the assumption that the weekly 200 creates a bottom on price action, and that would be all the way up to 50,000 roughly, running the liquidity above here. This type of move would definitely catch people off guard on both sides of the market, really, because I don't think anyone really expects that type of move, but it would also offer a unique opportunity. So like, for example, this area doesn't offer a great leverage long opportunity. This area would also not offer a great leverage short opportunity, but for accumulating and distributing spot, these areas are really ideal. I mean, this area is peak fears you're going to get for obvious reasons mentioned before. But if you had a retracement up here, I would definitely sell this level. I mean, first of all, it's a 618 retracement. It's a breach of these very significant swing highs in liquidity that rests above these swing highs of up here. And this is the area where all the bears or the people bearishly inclined would capitulate. So if price ran up here, this is kind of the area where a lot of different traders would, maybe people who are trading the macro, people who are, looking at the issues in the economy, and they just have a bearish mindset, that's reinforced by the declining prices. A lot of those people, if price traded above $50,000 in Bitcoin, would switch their bias at that point and would be enticed to enter a long position. And that's exactly where I would want to, sell some of the Bitcoin that I have, just because, there's a high likelihood that at the very least price would stall there, and if it, maybe retrace, and even if it did continue, it's still a good practice just to manage risk in that way, manage risk and profit. So that's something I would be keeping an eye out for. Again, I think this phase in the market is really a phase in the market that will test people's patience. So I think, this is the area in the market where it's not a great idea to have extreme opinions, to just carve out a little slice of edge and just use that over and over. Anyway, if you